Hey everyone, it's Nick with Us versus Herd. If it's your first time here, hit subscribe. If you haven't yet joined or subscribed to our new options trading live channel, link is below in the description, along with our Discord and our free options trading group. And if you find this video of value, please hit the like button. It helps me out a lot. Hit the like. I definitely appreciate it. But what we're going to get into is Tastyworks analysis mode. And what it does, it kind of helps you visualize where price action on an option contract or multiple contracts are going to go in the future if you place a trade. So you can kind of visualize where that trade will go with the stock price closer to expiration. And we're going to do a couple different trades. You can do this with any options trading strategy, and I think it's one of the most overlooked things on the platform, mainly because most people click on it and they don't realize what it is, and they don't take the time to actually study what this is. So that's why I'm doing this video, so that way hopefully it helps people. Helps people in the UVH fam to visualize your trades, visualize where you want to go, because good trades require planning, and that's what the analysis mode is for, is to plan. And if you guys like Tastyworks, there's a link below to sign up with my referral code. You don't have to, but if you want to, helps me out. Appreciate it. So we're going to get into the analysis mode here. You have to be on the trade tab, and as you can see here, we have table, curve, active, and analysis. Now, if you're on table and you hit analysis, you're like, what in the world does this do? This slid out, this came down. You don't know what's going on. And for analysis to really work, you have to be on the curve page and then select analysis. Okay, but before we get into that, I'm just going to cover a trade here and my thoughts behind it. So MU, they had earnings today. This was kind of a planning for earnings and trying to pick if I wanted to trade it, not trade it. IV rank was a little bit low. I did sell some options on it, which I currently have a position. As you can see right here, I'm short the 53 put, the 53.5 call. I'm long the 57.5 call, and I'm long the 49 put for next week. So, you know, I use the analysis mode to help me determine what expiration, what strikes, and how that was all going to go together. And right now I have a position on, but I'm actually going to do a new position. I'm going to just show you what the position would be like at close. So MU, it closed at 53.04, had a $4, almost $5 expected move for earnings. That's for next week. This week had 104 IV implied volatility and a $4 move. So, you know, I went with next week to buy us a little bit more time. But what I did here, let me show you this how I analyzed this, how I was playing with the strike. So, you know, right now it's telling me for this position, if I were to open this position at close, I'm gonna get a 286 credit. I'm gonna have a max loss of $114, and I'm going to go to analysis and kind of show you how that works. Now it's going to show up my position. I don't want to show my position. You can actually uncheck these. This is my current position. I'm going to uncheck these so it doesn't show up and skew the numbers here. So this is if I don't have a position right now, what it looks like, and this will show for you if you don't have a position yet. And you'll see once that's split out, you're automatically brought to the analysis tab here, and you can have a few different options here, but we're going to get back to this in a little bit. So let me actually slide this back, and we're going to go to the curve screen, kind of show you everything that's going on with this on the curve screen right now. So right now, let's put this in here to look at this P&L Theo. So that means theoretically, so it's going to show us the theoretical price. So if this were to happen, if the stock were to go into these circumstances, what we're having, I'll talk about a little bit more of this. So it's not a real price. It's matched up what your parameters are and how much money you'll make or how much money you'll lose if those parameters are met. P&L expiration, exactly that. It's how much you'll make or lose if this expires. If this expires right where it's at. And so this is a little bit, I would say, for most traders, especially people that are coming from Robinhood, you're looking at this like, holy crap, this is insane. This is I have no idea what's going on here. There's numbers all over. I don't know what's going on. So let me walk you through it right here. So this is my position that I'm thinking about, right? And if you can see this little red flag right here symbolizes where the stock price currently is. So it's at 53.04, and as you can see right here, this bar right here is the stock price. So this bar in the middle right here, 53, 53 and a half, 54, 54 and a half, measures the stock price, right? And this visualize where those calls or where those puts are. So right now, what we're looking at is, let me make sure we're on the clear. Okay, yeah, I only have this position selected. So if I were to put this on, I'm looking at a 286 credit, and you can see here the green is where you're going to make money, the red is where you're going to lose money, and right here is your break even. So right here is where you're basically going to be making or losing money, you know, up 1 cent, down a cent, or break even. So as you can see here, if you're looking at this little flag here, it shows you the date, the price, your P&L for expiration, and your P&L theoretically. So I haven't changed any of the parameters yet, but I'm going to show you how to do that. So this is if you were just looking at this trade, if nothing changed, if the stock did nothing. So earnings came out, stock stayed the same, implied volatility stayed the same, everything stayed the same. You know, you're looking at the sweet spot here. Theoretically, tomorrow, if the stock stayed the same price for earnings, I'd be making theoretically $27.38, as you can see up there. And then if I were to hold to expiration, I would make the full max profit of $286. Now, if I swing this way, let's go to my left. If it comes down, let's say for instance, tomorrow it stays the same, comes down to 51 and a half. Theoretically, tomorrow it's going to be worth $18. I'll make $18 in profit if it came down to 53.50. And if I held this position till expiration, I would be making $136 out of the $286 max profit. So that'll show you kind of where that the pricing will be. And you're like, hey, why would you do this trade? Why would you put this trade on if you're only gonna make $18 if it stays in your sweet spot? If you hit it perfectly, if the stock stays completely flat. I mean, my thoughts on MU, I'll review in a second, where that the stock was going to stay flat. So even if it does stay flat, you're putting up $114 to make $27. I mean, that's not bad, but you know, why would you put this trade on? And this is where the analysis mode really comes into play. So let me slide this back out here, and this is where you can control theoretically what happens on different expiration dates and different days in the future. So, you know, this is taking it for granted for what it is today. So if I click today, this is what the option pricing is reflecting today. However, I want to know how much it's going to be worth tomorrow, right? So if I hit this, push it forward 1 day. If I push it forward 1 day here, you can see that these numbers change. Let me go back real quick. You can see to keep your eye right here on this 50 here, because if you push it forward 1 day, it's keeping track of theta and your deltas and everything that makes this trade happen. So if I push it forward, look, now my break even is a little bit lower, so it's giving me a little bit more leeway. So I have a little bit more room, and you know that. You know, MU's IV rank is rather low going to earnings, but it's probably going to drop even lower after earnings. So, you know, now you can see by me just moving it up 1 day after the event happens on December 19th. So tomorrow, it's going to be worth. It was worth theoretically. This position was worth. If it stays flat tomorrow, it's going to be like $35. Yesterday or before I switched the date, it was like 27. So if I go back 1 more day, look, December 18th, yeah, 27. If I push it forward 1 more day, it goes to my P&L theoretically is going to be $35, okay? So it's getting better. Now, if I push it 1 more day, let's say I go till Friday, now if it stays flat, my P&L was $44. So it went from $27 to $44. So you can see how it's accounting for theta and the option pricing and how that reflects. Now, to make it a little bit more interesting, so this is an earnings play. To make it a little bit more interesting, you can change your implied volatility. So since this is an earnings play, let me go into the 19th. I want to see how much this is going to be worth tomorrow. So I'm going to go to the 19th, and we can scale in. We know that after earnings, implied volatility is going to drop, and let's just be conservative. Let's say, now it's showing, just keep in mind here, if it stays flat, it's saying my P&L theoretically tomorrow is going to be 35, but we didn't account for an IV crush. So let's account for an IV crush here. So you pick your expiration here. Right now I'm in the December 27th, so 9 days out. Now if I hit, let's be conservative. Let's say we only drop 20% in implied volatility. It'll probably drop more, but let's just be conservative. So now it got a bit wider, and it's saying now because of that IV drop, my P&L theoretically is going to be $95. So it went from because of that IV drop, it went from $44 to $95. So it's like, wow, if it drops even more, I mean, if we say negative 30, now if it stays flat, it's going to be up $142. So it went from, now if I reset this back to 0, you can see, now we're back at the $27 that we were going to make. So not great. So that's why it helps to visualize what happens and play different scenarios, and it will help you determine what the strikes are. So let me just set some perimeters. So I want to see how much this is going to be worth tomorrow. I'm going to just do a conservative 20% drop on implied volatility, and let's walk through this trade. So now you can see here, we did get a little bit wider. Now my break even is at 49.5 on the put side, and we're at like 57.25 on the call side. So tomorrow, even if I press, I could go as high as 57.25 or as low as 49.5 and break even if earnings goes crazy. Now, your expected move for this was almost $5, so it could go up to 58, or it can come down to 49, 48 area. So we're kind of in that zone. So even if it does come down to $49, theoretically I'm going to be losing like $19. If it goes up to $58, theoretically I'm going to be down on that position $25 tomorrow. So this seemed like a good risk scenario for me. And as you can see here, you have the P&L theoretically right here. You could change that. P&L theoretically will show you, how much money you're going to be making in here, or how much money you're going to be losing when it turns red. But I mostly use this little banner thing that shows you the info. It's called info. You could turn this off or turn it on. I use the banner just because I slide my mouse to see, okay, if it's $51 tomorrow, theoretically with these circumstances, I'll be making $50 on expiration. I'm not going to hold this to expiration, but this is going to be worth $91 if we have a 20% IV drop and it stays within this scenario here. And then you can definitely play around with the strikes and how that moves. But I'm going to set up another position here on a different stock. So that's how I picked those strikes and what I thought was going to happen. Right now, MU is currently at 55.5, close at 53. After hours are at 55.5. So what we're looking at tomorrow, if it's at 55.5, I'm going to be potentially making anywhere between, let's say it's between 55.5, 56. I'll probably be making like $45-50 out of the 286. But I only risked $114. So, I'm really making like 50% on the trade on my money. So I risked $114, and I'm going to be making $40 to $50 on this trade, and you can scale the contracts or whatever you want to do. But that's kind of how you play around with it. Now, of course, you can change whatever you want to do. Now, let's say if you want to do like a traditional iron condor, And let's do like a one standard deviation out. Let's just say you're going to do something like this, and we'll sell this guy. Let me just make sure I don't have. Okay, good. So we go to analysis, go to the curve screen. So for this to be profitable, okay, let me zoom in a little bit here. I'm getting a 20-cent credit. However, I have 4 options. I have a max loss of $30, and so it's going to cost me about $4.50 for this trade, and have to come out of this 20 cents. So you can play around with it. So this trade didn't look too appealing to me. Yes, it does have to stay, but you can see for a higher credit, it's still between the same. Like, it has to be between 49 and 57. So I picked the higher credit and higher probability versus doing like a standard iron condor like this, where you're only getting 20-cent credit and you'd have to scale up the contracts to make money. Versus what I did, was I sold these guys. And as you can see, if we go back to the curve, the profit, I mean, there's a little bit less. The traditional Condor came down like 49. However, my break evens are still, I'm basically at 49.5 and 57.5. However, I get a whole bunch more credit. Yeah, sure, I'm risking more money, but I'm getting a whole lot more credit, and the profit zone is a lot more sweeter. So let me walk through another trade. There is Nike earnings coming up. I'm not going to just do earnings, but I just want to show you, what happened. So Nike has earnings coming up. Let's say you were planning out an earnings trade on Nike, and let's say we wanted to go into this week's expiration, and let's say we wanted to do, we think it's going to go up. Let's say we're going to sell a credit put spread like right at the money. Okay, let's say we're going to sell a credit put spread right at the money, and we can see what happens to this on expiration, because this is going to be tomorrow, and we want to see what it's going to be after the event on Friday. So let's go to here, and let's go to, you have to have analysis check. Let's open this up. We have our position. So let's select, okay, we do have tomorrow, and let's say out of the 67%, we drop another 20%. So on this position, I'm going to be, if it stays the same price, we're going to be up like 25 cents or so, $1. And then if it moves up to $105, we're going to be like pretty much max profit. Let me zoom in a little bit here. If it's at $102, I mean, theoretically we're going to be like $14, but eventually we get capped out when it comes up to 105, 104. Now, let's say you wanted to push this forward an expiration. We can push this forward in time. Just hit the time button, and you can kind of see here what happens to that pricing, and just play around with it. Now it's saying that, I don't know if that it doesn't look right. So okay, let me just make sure we're in the right expiration. So we're on 9 days. Yep. And then we're at the curve screen here. So yeah, now it's saying our break even's not till 103. Let's just clear that. Let's try it again, because I don't know if that seems right. Let's go to, yeah, it didn't look right, because now our break evens, it should be like right here, yeah, like 101. And if we go to 105, theoretically tomorrow it'll be like $28. So you can kind of see that. Now, let's say you wanted to just do like a single contract. Now, let's say you wanted to kind of price out Amazon, right? So let's say we want to, right now Amazon's $17.84. Let's say you think it's going to hit $1,800, but you're not exactly sure what point in time it's going to do it. So maybe you buy something like 30 days out. Maybe, hey, earnings are January 30th. And it's, maybe I'll play like a run up into earnings. Maybe I'll do January 17th and think that's going to run past my strike into earnings. Let's say I want to buy this. It's kind of pricey, $27. Let's see what happens with this if I were to put my money in it. Like, how much, if the stock stays the same, how much money I'm going to lose at theta over time, and kind of go from there. So we're going to go to it. We still have analysis mode checks. We're going to go to hit the curve screen. And right now, as you can see, we have our call here. Let me actually switch it for today. And now if nothing changes, you know, we need it to be, let's zoom in a little bit here because there's a little bit bigger numbers, so you can see a little bit better. So right now the price is $17.85. We bought the 1800 call, so if it comes down a little bit here, if it goes up to $17.90, theoretically we're going to be up $700. Now we don't really care what happens to it today. Let's see what happens to it. You know, let's say if I buy it, let's say we bought it today. Let's see what happens on December 27th, like over a week from today. What happens if nothing changes, right? So let's hit this. Okay. So now we're analyzing what's going to happen about, you know, on December 27th, which is 11 days from now. What's going to happen? So what price do I need it to be? So now on expiration, as you can see, if I hold it, I'm going to be losing $2,700. My theoretical price on that day, I'm going to be up $500. If it's $1,800, if it goes to $1,805, I'll be up $900. However, at expiration, if I were to hold, it's going to be 22. I'm going to have a $2,200 loss. So now you can see where theta is going to start trying to kick into where this pricing is going to go. Now, let's say during this event, implied volatility increases or decreases. You can kind of play with that. We're not going to get to that right now, but you know, let's say implied volatility does increase, like because it's relatively low right now at 18%. Let's say it goes up 10%. You can kind of see how much your pricing will change. But let's just keep it flat right now. We're just going to keep it flat because just for example purposes. But you can play around with all these numbers and ideas and just really confirm your option pricing, confirm your belief. And this also is going to help you understand how theta and delta and all that stuff work moving forward in time as the stock moves and what price you need at a certain time. A lot of people ask me, hey, if this stock moves at this price tomorrow, how much is it going to be worth? And you can do the calculations yourself. You know, it takes some time, but you can do it. Or you could just hop into Tastyworks analysis mode and, you know, pop these numbers in and see. Now it's theoretically, I mean, nothing's ever 100%, but let's see what happens now when, let's say we're getting a little bit closer expiration. So we have the January 17th call. So let's say we went into another week. Let's go to January 3rd, okay? Now, as you can see here, my break even's now moved up to 1800. My break even before was down here a week before. So let's go back real quick just to kind of show you. A week before, the prior Friday, the 27th, the prior Friday, my break even was $17.90. Fast forward a week, now my break even is $1,800. So you can see how theta has really eaten into that pricing. So now my break even is 10 points higher. And then if you even go off a week forward, so we have the January 17th, let's go to the 10th. Now, in order to break even on this option that I've been holding closer to getting the expert, I need 815 to break even on it. So holding the option, let's say you're in the money, holding the option, let's say you're right at the money, holding the option is not going to be worth it. So let's say the stock price stayed the same, you're going to need 1815 for it to actually be break even. You won't be making money. You're not going to be making money until you get after 815. At 1830, you're going to be making $1,100, but I mean, it pushes that much forward. So that's why when buying options and waiting and holding, you can run the numbers. It's not going to pay to hold. That's why people try to squeeze the juice out of it and say, hey, it's going to go higher, But what if it doesn't? What if it stays the same? You can kind of run those scenarios on those options through this analysis mode. So, if you have questions, I know we covered a lot, leave a comment below. If you want to join Tastyworks, use the link in the description. If you like the video, like the content, hit subscribe, hit the like button. I appreciate you guys. And as always, stay safe, stay green. It's us versus herd.